So I'm excited to have Mr. Lior Gantz on the line today. We've spoken twice in the past. Mr. Gantz is an investor and owner of wealthresearchgroup.com. Mr. Gantz, thank you for joining us today.
Thanks for having me.
Great. So I just in past interviews and listening to you being interviewed on either Kitco or other places, what can you tell us about your gold ownership in physical metals and how much and what's the purpose of that, of you holding that?
Yeah, my safe number is, no, I'm just kidding.
Yes.
What do I think about gold ownership? So for me, once I started to understand the purpose of owning gold as basically as a cash alternative, as a way of protecting one's savings in a form that isn't tied to fiat currencies, I wanted to make sure that I have enough so that if the central banks royally screw the system, that I have enough for my family unit. So what I did is calculate how much the family unit spends, and then I multiplied it by 2 years. And I arbitrarily took 2 years because, depression in modern era is normally been 2 years or less. It's, let's say, $5,000 as much as, for the sake of this exercise, then I take 5,000 times 24, get $120,000. You convert those savings from fiat currency into gold physical, and that's basically enough. Or if it gets to a point where it's less than 5% of your entire net worth, I would up it to 5%. I would say that 5% is a good amount to have in gold if your other 95% are in cash flowing assets and not in just in cash.
And so if you're looking to hold your gold long term, either at today's prices or just in general, when's a good time to be purchasing gold, and is now a good time to be buying gold?
Well, if you look at the last 51 years, the best time to buy gold is as early as possible, because gold has gone from 35 an ounce to around 2,100 just 2 years ago. So if you look at history tells you buy gold. It's a good time as any. So when I look at what I see today I see that the Fed literally told you it wants a positive yield curve from the 2-year to the 30-year. So this is a very bad time to be aggressive with gold. What you want to do is you either want to nibble if you don't have enough, or you want to wait until such time as the Fed gets to that credit event that we're going to see. We saw it in the UK, but we need to see one in the US because they're tightening very aggressively and irresponsibly. And once that credit event happens, then you'll get to some plateau, some range where gold trades at. In my opinion, it will be in the mid 1450s. And I think when that happens and you start to build that trend line up, you'll have enough time to start buying at those levels. I don't think personally that we are going to see a V-shaped recovery in most asset classes. I think you have time to really build position. This is not a recession. This is a reset. And in a reset, things take longer to really get it over to the other side. We literally think there will be no zero interest rate policies in America in this business cycle. And maybe for the rest of our adult lives, who knows, but for sure, not in this business cycle. So if you haven't read our research on this, I really urge you to download that report at wealthresearchgroup.com/ZERP and understand why it's over. Like we've finished that experiment of zero interest rates.
What distortions has running a zero interest rate policy produced, and are those distortions being normalized now or soon?
Oh, great question. I think that for the longest time, they did not produce the immediate results that everyone assumed that they will. If you were in the markets in 2009, everyone thought this is going to be hyperinflationary. Silver went from 9 to 49, gold went from 800 to 1900 and something. But then by 2011, it became apparent that it doesn't really matter the amount of credit that's pumped into the banking system. What really matters is how the public behaves towards this new credit. Because if that credit isn't trickling to Main Street via loans or consumption or otherwise, and it stays on the balance sheets of the banks, if they can't lend it to the public, what they do is they get it from the Fed at 0, and then they lend it to the Treasury Department at 2, and they make a 2% arbitrage, and that's a great business model. No risk, make 2% of billions of dollars. And that's what you saw effectively for between 2011 and 2016 when they start to raise rates again. So now they're chasing it. They are now killing the wealth effect, so that you and I and every other person looks at his bank account, look at his brokerage account, look at his real estate holdings, and says, what a mess. I need to stop spending so much. That's how you get inflation back down. But there's a lot of collateral damage doing that. I think that they're at a point where now they're risking more than just this guy losing his job and this guy being upside down on his home a little bit. And we're now risking the system. You saw it in the UK, and you will see it if they continue in the US. At that point, that's where we defer from the markets. The market think there's a credit event, they will go back to emergency rate cuts, etc. We think they'll say, okay, we may have done it, we may have overdone this. Inflation is still a problem. We're going to stop, we're going to pause, and we're going to see. We're going to see what happens. But we're not going back down. Inflation is still a problem. We're not going back down. That's where we believe that the markets still have it wrong. And in my opinion, that's how we will get to that new normal where interest rates are fairly normalized compared to what we've seen them in the last 13 years. We will have 5 or 5.5 or 6% CPI numbers for a few years, and they will not be able to really stop that. And if after the most aggressive tightening cycle since Paul Volcker, the yield curve is still negative in real terms, in other words, inflationary expectations are still at around 0 or negative, then you can really start to see how gold and silver have formed a really great base for a really aggressive bull market on the other hand of this.
Where would a gold market go to? What's the price range and timeline?
So if my analysis is right, and we're going from the DXY being at 113 today to around 80 by the end of the business cycle, I think gold is going to between $3,000 and $4,000. And I think that silver, with this particular time, if we look at either a 50 or a 60 to 1 on the gold silver ratio, I think silver is going to between 60 and 80 an ounce during this business cycle. I know most people think it's very high, but silver is such an industrial metal that it comes into micro doses into most of the products that it's in. So even if silver is 50 or 60 or 70, it doesn't really change the price, the end price of consumer items that it's in, and it's in thousands of them. So don't think that just because it's an industrial metal, the price of it has to be down. And think also about the fact that it's mostly a byproduct. So if the price goes up, it's not like a lot of silver mines can come into production right away and fill up the gap. So just keep all these things in mind. It's not far-fetched at all to see silver between 60 and 80 during this business cycle.
So, Mr. Gantz, I really appreciate all of your insight. Thanks for joining us today.
Thank you, sir.